Good evening and welcome to New York City, here in front of the NASDAQ stock market. I'm Tom Williams. I'm with Aligned Independent Advisors. Happy New Year. So the U.S. equity markets today digesting the news from the Fed minutes, supporting our view. We believe 2014 will be a very good year for the markets. The news today that the ADP jobs number at 220,000, 230,000 jobs created, versus consensus of 200,000 just reconfirms our bullish view that we see the equity markets moving higher in 2014. Although we do believe 2014 will be a year of increased volatility. If you look at 2013 was a year of very low volatility. Many investors have taken comfort in the low volatility, but we believe 2014, for several reasons, will be a return to volatility. Part of the reason for the return to volatility will be the Federal Reserve tapering. Also, it is historic that most central banks do not do a good job of preventing dislocations in the markets as they make monetary policy adjustments. And the U.S. is certainly prone to that as well. So we do see a return to volatility in 2014. In addition, another reason for volatility is the investor sentiment is very bullish this year. We feel that maybe markets might be a little bit ahead of themselves, and we do anticipate a 7 to 10% pullback here at the beginning of the year. But by year end, we do believe that the markets will have recovered and we'll have a nice, strong, positive equity market by year end. Maybe not as much as 2013, but still very strong. Leveraging off of that, we also see a very strong US dollar. Of course, the currencies are always in pairs. But we believe that the Fed's quantitative easing coming to an end with the tapering and rising interest rates in the U.S., we believe that will give a lot of headwinds for the U.S. dollar, and particularly the currencies that we see weakness against, Canadian dollar, the Australian dollar. Both of those have had struggles in 2013, and those will continue in 2014 due to the hard commodity impact on the countries, and they have an outsized impact to their economies because of the hard commodities. And so with the US dollar strengthening and their currencies weakening, we see a significant move there. The other currency that we see is the Japanese yen continuing to weaken. As we all know, last year the yen weakened quite a bit from 79 up to 100, and now it's creeped a little higher since the year began. But we see a second leg move in the Japanese yen due to quantitative easing in Japan, and also the Fed actions in the US and the rising interest rates. Having said that, we believe that the knock-on effect will be a second leg up in the Japanese equity markets. So investors last year were very happy with their Japanese equity returns. Those who invested in the Nikkei first 5 months had a very large increase, and then during the summer we saw some sideways action, and by year end Japanese equities were back up again. And we continue to see a second leg coming here in 2014, partly due to the currency, and secondly due to the recovering U.S. economy, as those Japanese export companies need places to sell their products. We do highly recommend that if you're going to be long Japanese equities, that rather than just buy the US dollar investors, rather than just buy the iShares, that we recommend you buy the WisdomTree ETF, as it is yen hedged, because the increase in the equity market in Japan will be offset by the currency move, and to maximize that you want to be hedged on your yen, and depending on your sophistication level you may not be able to do the hedge yourself. So if you buy the WisdomTree ETF, then you'll be able to have the hedge for you. Having said that, we also feel that the Japanese exporters will do the best of the Japanese equities if you're looking to buy sectors, and also Japanese financials, as they will do better with the monetary policy environment. The two financials that we feel very strongly about, Nomura and Daiwa, should benefit significantly from these policy moves. The